Hedge funds. What do they mean and how do they work? And there's a clever little known version of this most exclusive investment type, which works a lot like an ETF, which is the most mainstream investment type. We'll get to that in a minute. I think the direction to start with explaining hedge funds is who they're allowed to be marketed to. In the EU and the US and most other highly regulated jurisdictions, that means basically nobody. In other words, they aren't allowed to publicly market their fund. For example, if you go to the website of a hedge fund, it'll probably be a single page, 8 or 10 words on it, not that much to look at, maybe a picture or two. Certainly no performance details, fact sheets, charges, risk analysis, or anything that we're really used to with funds. And that's if they have a website at all. Most hedge funds don't. And you'll never see any TV adverts or internet adverts for hedge funds. It's simply illegal to publicly market them. You need to be a very sophisticated investor or ultra high net worth, typically both, and they are presented at things like cocktail parties and via word of mouth. As far as charges go, the most typical charge type for a hedge fund is what's known in the industry as 2 and 20. That means a 2% annual management charge and a 20% performance fee, which is as it sounds. If the fund goes up by 50%, they'll take 10 of those percentage points and you'll keep 40 of them. And normally there's something like a high watermark, which means that if the fund goes, for example, down 20% in 1 year and up 20% in the next year, they won't take any performance fee at all because on aggregate it's stayed the same. In any case, performance fees for retail clients are illegal in the US and many other highly regulated jurisdictions. And that's one of the key reasons why they aren't allowed to market their product to the public. But actually, performance fees can be legal in some types of alternative investment funds within the EU. Now, they might be for self-certified, sophisticated investors, in other words, investors who say they are sophisticated investors, but they can be marketed, albeit with a lot of warnings and caveats. And that's a really key difference. A lot of investors that I've spoken to seem to, initially at least, really like the idea of performance fees, because to them it aligns the goals of the investment manager and the investor themselves. It doesn't. The reason why regulators hate performance fees is that they give a massive incentive to fund managers in order to push the risk right up to gambling levels, in other words, as high as possible. The reason why is that if a fund manager loses money, they don't charge a performance fee. If a fund manager gains 6%, 8% in a year, they make a performance fee that's almost nothing, and so why bother? But if a fund manager makes 60% in a year, they're rich. Hedge funds in general are allowed to hedge their bets, which means to bet on an asset going down in value as well as up in value. However, what a hedge fund is really allowed to do is pretty much anything it likes. You'll have hedge funds that are highly specialized. For example, you can find coffee and cocoa hedge funds that specialize in those commodities. They've been known to launch their own satellites to keep track of fields of cocoa, for example. And you can find very general hedge funds that specialize, for example, in the US stock market, but are able to make money when it goes up or down. And essentially, what they try and target is something that they call alpha. Alpha can best be explained in contrast to beta, which is brainless investing. For example, tracking the fate of the S&P 500 without trying to improve upon it at all. Fair enough. If pure alpha were to exist, it would be what's called an absolute return. There are funds called absolute return funds. And that's where a fund is able to make a consistent annual return, for example, of 10% a year, no matter what the stock market or any other market does. As you can imagine, this doesn't actually exist in real life, but it's what hedge funds aim to do, or what they say they aim to do. Like with funds in the public market, you have good hedge funds and bad hedge funds and everything in between. But because they don't release their performances publicly, you can't go on websites like Morningstar, comparison websites, and rank them best to worst. You have to be in the know, either, for example, as an institution, a pension fund manager, or a very high net worth individual. And even then, it's very difficult to find out. For the people running the hedge fund, the upsides are that they can do whatever they want in order to make money, and the charges are usually much higher than most retail funds because they say at least they're targeting alpha. In other words, they're using their brains a lot more and you're going to pay for it. And the liquidity can be much lower, which means if you want to, as a customer, sell out of your fund, they may not let you do that immediately. Hedge funds are essentially very much the Wild West of investing and offer almost none of the protections that retail clients enjoy, but also promise to produce both a higher return and, critically, a much more consistent return over time, avoiding stock market crashes and things like that. And this brings us swiftly to Bill Ackman. Bill Ackman's a hedge fund billionaire from the US that manages a hedge fund that you may have heard of called Pershing Square Limited Partnership, or PSLP. And this is based in the US and has about $2 billion under management at this point. It charges almost the standard. It charges 1.5 a year and 20% performance fee, all well and good. But 10 years ago, 2014, Bill Ackman launched another investment vehicle called Pershing Square Holdings. This is set up to work a lot like an ETF in its structure, which means that it sells shares of itself, like a company, to the public in an initial offering. But after that, if an investor wants to sell out, she would need to find another investor to sell those shares to on a stock exchange. Within the fund, it works a lot like a hedge fund, but from the outside, shares of it are traded like an ETF, which is great for the fund managers. If they do badly, they don't have to field panicked phone calls from clients to redeem, in other words, give money back to clients or to their investors. However, there are a couple of problems with this, as there can be with ETFs in general. The first problem is that the price of the shares of the fund on the stock exchange can differ from the actual value of the shares, which is also called the net asset value, or NAV. As an example, if a fund held shares in just two companies, say Microsoft and Tesla, and your share of the hedge fund was worth $50 worth of those two shares, the fund should then trade at $50. But what if the market expected those shares to go up, but also expected the fund manager to soon sell those shares and not benefit from that rise? Well, the fund might then trade at below NAV. We don't always know why a fund trades at a discount to NAV, but we do know that Bill Ackman's Pershing Square Holdings does. This might be because it's not incorporated in the US, where it wouldn't be allowed to advertise. It's incorporated in Guernsey and trades in Amsterdam, where performance fees are legal, but where he isn't a household name like he is in the US. But in any case, the fact that it trades at a discount to NAV means he can't really raise more money. If he did issue more shares to the wider market of his fund, it would dilute it. In our example, he'd raise $80 billion to buy $100 billion of Tesla and Microsoft. It wouldn't make financial sense to do so. He'd immediately lose $20 billion. Pershing Square Holdings tried really hard to address this discrepancy between the fund price and the NAV with a global marketing effort, but it didn't really work. So instead, it's doing something new. It's trying to launch Pershing Square US, which is a retail fund aimed at US retail customers. And in a recent presentation on its general structure and fees and whatever it assumed it would in its first year raise $10 billion, which is frankly a mind-blowing amount for any fund. But then again, Bill Ackman is probably the most famous investor in the US after Warren Buffett, so it might be accurate. And obviously, the point of launching a retail fund in the US in the first place. He's a household name. And for Pershing Square Holdings, the European vehicle, you start doing share buybacks, the opposite of a new issue, which would be profitable, in the same way as raising new money by issuing more shares would be loss-making. You could even, for example, borrow the money to buy back and retire those shares because you'll be immediately turning a profit with every share you buy back. The other thing about a retail fund that can't charge performance fees is that it's not always a bad thing when you're absolutely gigantic, as Bill Ackman assumes he's going to be. Because maybe you don't really need to. When you're a brand name, you have tens or hundreds of billions of dollars under management. Why take a performance fee when you can take, for example, a management fee and use your performance or use your success as a marketing drive to raise another $10 billion of inward investment and take a management fee of that instead? And if you run it as an exchange-traded fund, and if you're famous, do well, and it trades at or above NAV, no one on aggregate is ever going to get their money back anyway. So that's a little bit about hedge funds and latest hedge fund news, and I hope to see you soon.